2023, Elon Musk paid an effective federal income tax rate of approximately 3.27%. Jeff Bezos paid an effective federal income tax rate of approximately 0.98%. Warren Buffett famously admitted that he pays a lower effective tax rate than his own secretary. His secretary pays approximately 35.8%. Buffett pays approximately 17.4%. Between 2014 and 2018, the 25 wealthiest Americans paid a true tax rate of just 3.4%, according to a bombshell investigation by ProPublica. Meanwhile, the average ordinary American worker pays an effective federal income tax rate of approximately 13 to 22%. Ordinary Americans are paying between 4 and 6 times more of their income in taxes than the wealthiest people on the entire planet. And the reason why is not corruption. It is not illegal. It is not even hidden. It is a deliberate and mathematically precise system that was built specifically to work this way. Today we are going to show you exactly how it works, who built it, and what every ordinary person needs to understand about it. This is the single most powerful wealth preservation strategy used by the ultra-wealthy, and it is almost completely unknown to ordinary people. It is called the buy, borrow, die strategy. And here is exactly how it works. Instead of earning a salary, the ultra-wealthy accumulate wealth through appreciating assets: stocks, real estate, private businesses, and art. Assets that grow in value over time without generating any taxable income. Instead of selling those assets and paying capital gains, tax the ultra-wealthy borrow money from banks using their assets as collateral. This borrowing is not income, therefore it is not taxable. The ultra-wealthy then use that borrowed money to fund their entire lifestyle: mansions, yachts, private jets, and everything else, all funded by loans. None of it taxable. And when the ultra-wealthy die, their assets receive what is called a stepped-up cost basis, meaning all the accumulated gains that were never taxed during their lifetime are completely wiped out at death. Their heirs inherit the assets at their current market value with no capital gains tax ever paid on decades of appreciation. Elon Musk borrowed approximately $13.4 billion against his Tesla shares between 2018 and 2022. Larry Ellison of Oracle has borrowed billions against his Oracle shares to fund his lifestyle. According to Bloomberg, the 50 wealthiest Americans borrowed more than $750 billion against their assets between 2010 and 2020. $750 billion of completely tax-free spending power, generated without selling a single asset, without paying a single dollar of income tax, and without triggering a single capital gains event. Here is the fundamental mathematical unfairness at the heart of the entire tax system. When an ordinary American worker earns $5,000 at their job, they pay ordinary income tax at a federal rate of approximately 22%. That means they pay approximately $11,000 in federal income tax on $5,000 of earned income. But when a wealthy investor earns $5,000 from selling appreciated stocks, they pay capital gains tax at a federal rate of just 15 to 20% for long-term holdings. On the exact same $5,000, the ordinary worker pays approximately 22%, while the wealthy investor pays approximately 15 to 20%. But here is where it gets truly outrageous. The wealthiest investors do not even pay the 15 to 20% capital gains rate most of the time, because they use the buy, borrow, die strategy to avoid ever selling their assets at all, meaning their effective tax rate on their actual accumulated wealth is often 3 to 4% or less, while the ordinary worker earning a fraction of their wealth pays 22% or more. According to the Tax Policy Center, the middle 40% of American earners pay approximately 13% effective federal tax rate, but the top 1% pay an effective rate of just approximately 25% on reported income, and far less on their total actual wealth accumulation when unrealized gains are included in the calculation. The buy, borrow, die strategy is just one layer of the ultra-wealthy's tax minimization system. The second layer is offshore wealth. According to the Tax Justice Network, between $21 and $32 trillion of private financial wealth is held in offshore tax havens around the world. $21 to $32 trillion. Hidden from domestic tax authorities and jurisdictions specifically designed to protect it from taxation. The most popular offshore tax haven destinations include the Cayman Islands, British Virgin Islands, Luxembourg, Switzerland, Singapore, and Ireland. The Cayman Islands alone holds financial assets worth approximately $4.5 trillion in a territory with a total population of approximately 65,000 people. That is approximately $69 million of financial assets for every single person living in the Cayman Islands. According to the EARS, the United States loses approximately $600 billion in tax revenue every single year to offshore tax avoidance and evasion. $600 billion every single year. That is enough to fund the entire United States education system twice over. Apple has historically held approximately $250 billion in offshore cash. Google has held approximately $60 billion offshore. Microsoft has held approximately $142 billion offshore, all legally structured to minimize or eliminate taxation on profits generated by ordinary American and European consumers. There is a third layer to the ultra-wealthy's tax minimization system that is perhaps the most cleverly designed of all. The charitable foundation loophole. Here is exactly how it works. A billionaire donates appreciated stock to their own private charitable foundation. They immediately receive a tax deduction worth the full current market value of the donated stock without ever paying capital gains tax on the appreciation. The foundation then invests those donated assets, and the investment returns grow completely tax-free inside the foundation. The billionaire retains significant control over how the foundation's money is spent and can pay themselves and their family members generous salaries to manage the foundation, all tax-free. The foundation is legally required to donate only 5% of its assets annually to actual charitable causes, meaning 95% of the assets can remain invested and growing tax-free indefinitely. Bill Gates donated approximately $35.8 billion worth of Microsoft stock to the Bill and Melinda Gates Foundation between 1994 and 2018, avoiding an estimated $10 billion or more in capital gains taxes on that appreciated stock while retaining significant influence over how those assets are deployed. Mark Zuckerberg pledged to donate 99% of his Facebook shares to the Chan Zuckerberg Initiative, a limited liability company rather than a traditional charity, giving him even more control and flexibility over how those assets are used while still receiving significant tax benefits. The foundation loophole allows the ultra-wealthy to simultaneously avoid taxes, maintain control over their assets, and receive public credit for extraordinary generosity, all through a single legal mechanism that ordinary people have virtually no access to at any meaningful scale. The ultra-wealthy do not just minimize their personal taxes, they also minimize the taxes paid by the corporations they own and control. In 2020, 55 of America's largest and most profitable corporations paid $0 in federal income tax. $0 on combined profits of approximately $40.5 billion, according to the Institute on Taxation and Economic Policy. Companies that paid zero federal income tax in 2020 included FedEx, Nike, HP, and Salesforce. Amazon paid an effective federal corporate tax rate of just 6% in 2021, despite reporting profits of approximately $35 billion. Netflix paid an effective federal corporate tax rate of just 1.1% in 2018, despite reporting profits of approximately $845 million. The official United States federal corporate tax rate is 21%, but the average effective rate actually paid by S&P 500 companies is approximately 11 to 13%. And for the most sophisticated tax-minimizing corporations, it is often single digits or zero, all completely legal, all specifically designed to minimize the tax burden on corporations and their wealthy shareholders. While ordinary workers and small businesses pay their full statutory tax rates without access to any of these sophisticated minimization strategies, here is the complete mathematical picture of exactly how the tax system actually works in practice. The total wealth of American billionaires grew from approximately $2.9 trillion in March 2020 to approximately $5.8 trillion by October 2023, an increase of approximately $2.9 trillion in just 3.5 years. The true tax rate paid on that $2.9 trillion of new wealth accumulation was approximately 1 to 3%. Because most of it consisted of unrealized gains on appreciated assets that were never sold and therefore never taxed. Meanwhile, ordinary American workers paid approximately $1.5 trillion in federal income taxes in 2023 on earned incomes that were a tiny fraction of the wealth accumulated by the billionaire class during the same period. According to Oxfam International, the world's 5 richest men doubled their combined fortunes from approximately $405 billion to approximately $869 billion between 2020 and 2024. While approximately 5 billion people around the world became poorer during the exact same period, the global tax system is not broken. It is working exactly as it was designed to work, for the people who designed it. So, what can any ordinary person do right now? Understand the difference between earned income and investment income. Every dollar you earn from working is taxed at ordinary income rates of up to 37% federally. Every dollar you earn from long-term investments is taxed at capital gains rates of just 15 to 20%. The single most powerful tax minimization strategy available to ordinary people is to shift as much of their wealth-building activity as possible from earned income to investment income over time. Maximize contributions to tax-advantaged retirement accounts, including 401k plans and IRAs. The maximum 401k contribution limit in 2026 is approximately $23,000 per year. For a worker in the 22% tax bracket, that represents an immediate tax saving of approximately $50–60. Consider a Roth IRA for tax-free growth. All investment growth and withdrawals in retirement are completely tax-free. Hold investments for longer than 1 year to qualify for long-term capital gains tax rates. The difference between short-term capital gains rates of up to 37% and long-term capital gains rates of 15 to 20% on a $5,000 investment gain can represent a tax saving of approximately $8,500 to $11,000 from a single decision to hold an investment for one additional day, beyond the 1 year threshold. Here is the single most important number in this entire video: 3.4%. That is the true tax rate paid by the 25 wealthiest Americans on their actual wealth accumulation between 2014 and 2018, according to ProPublica's bombshell investigation into heirs' tax records. 3.4%. While the average ordinary American worker pays approximately 13 to 22% on earned income, that is a fraction of the wealth those 25 individuals accumulated during the same period. The wealthiest people in the world do not actually own anything. Because ownership implies tax liability, they control everything through borrowed money, foundations, offshore structures, and corporate entities that were specifically and deliberately designed to preserve and grow their wealth while generating the absolute minimum possible tax liability. This is not illegal. This is not hidden. This is the financial system working exactly as it was designed to work. The only question is, now that you understand exactly how the system actually works, what are you going to do with that knowledge?